Hi friends, so in this final bit of our video, as usual, I'll be looking at the revenue. I'll take a very quick overview of what that we have done, then we wrap up from where we left off, okay, as the part 3. Okay, so as I share my screen, let me start from the onset, okay. Just a quick overview over all that we've done. Okay, so I will use my slide. Okay, this one is not dropping. I don't know why, but stop sharing once again. Let's start. Getting some difficulties from my end. Okay, so this should work now. All right. Okay, so overall, from what we have done, what we have watched from the videos, we've looked at the development of revenue, where one standard has come to replace a couple of others. Okay, and we've looked at the 5-step model. Okay, at which point I think we finished with the contract obligation, price, allocation, and revenue. That's where we talk. The recognition is where we are just to finish up. Okay, so for each step, we've taken an example, we've taken illustrations. Okay, we've gone through and I determined the transaction price. Here we looked at an example under financing, yes, and I think we look at an example at consideration paid. Okay, and then, so that is the explanation given, of course. And then these illustrations we took under that. And then revenue recognition, we looked at the financing. Okay. Now, I think we went on to look at where it's more or less giving, like, it's like giving a loan to this person. The person pays over time. Okay. And the situation in terms of where we discount it using the time value of money. Okay. We looked at this. The allocation, we also clearly assigned it, looking at sometimes you want to use clearly split them between the service cost and the actual asset. Okay. And I will took an example. Very good analysis where you think outside the box. Okay. All right. So, and then recognition, when we satisfy over time, measure the progress, up what the percentage of work done, and what is the percentage of money you've received as at now, pending the final stage of completion. And okay, then we talk of look at the criteria. You should meet either one. If one of them is met, you satisfy that. Okay, over time. Okay, so we proceeded. Took the input output method. Okay, where we're looking at the cost to date. Okay, as a percentage of the total cost to date, right? And then we took the output. We're talking of the value certified over the total value of the contract price revenue you expect to get a stage of completion. Okay. And then I came to this point where I looked at recognizing an asset, a contract asset or a contract liability, and how to measure it. Okay. So at this point, we'll proceed from here. What about situations where you make a loss from the contract? It happens. Sometimes you produce, sell to someone, and you end up making a loss. Okay. Now, when it's estimated that your contract will produce you a loss other than the expected gain you would all have ordinarily thought, this loss must be recognized in full by increasing the cost of sales. So write it off to your cost of sales immediately. The simplest way to calculate the cost of sales figure is to add this estimated loss to the revenue figure. That's the easiest way. Okay, so it will be the cost of sales will simply be the revenue you expect plus the loss. Then it knocks off everything. Okay. What if we have rectification costs? Sometimes you would have finished constructing the road and then the government would tell you that if within 6 months we identify some potholes or some errors with the work, you got to go and correct it, rectify it. Normally, it happens in road construction and even in building. When you have built a house and after 6 months or within 2 years, we end up seeing some cracks on the building. What happens? When costs are incurred to rectify errors, we are seeing that these costs are not recoverable from the customer because you did perhaps a shoddy job. Okay, so these costs should not be included in the profit calculation. Instead, you should recognize it in full as period cost in the period in which it occurred, as period cost immediately. Okay, don't include it in your profit calculation. Now, again, sometimes there are some costs we may not really know. Future unknown costs. The future is uncertain. What happens? Okay. Now, it is where it is not possible to estimate these future unknown costs. Okay. We are saying that only recognize your revenue up to the value of the recoverable costs incurred to date. So I'm not really sure of the future. Apply the prudence concept. I don't know the cost I will incur. So what I will do is that I will equate my revenue to the cost up to date so that I get a nil. Okay, a nil profit totally. Okay, so let your revenue be equated to the recoverable cost that you think you will incur. You would have incurred up to date. I've incurred up to 500. I don't really know the cost I will incur in future. Equate my revenue to my cost. Nil, zero profit, break even. Okay. Let's take an example in terms of construction contract. On January 1st, 2014, NIM entered into a contract with a customer to construct what? A specialized building for an agreed price of 30. Specialized building. Now, at the end of the year, NIM incurred costs of 14 million. And he estimated that the cost to complete the contract would amount to what? 7. In reality, this guy is estimating a total cost of the 14 plus 7 to give us 21. So he would be expecting a profit of what? 30 million minus 21, which gives me 9. Don't we know this? It's easy, right? Very easy to identify. NIM measures progress towards the contract completion using the input method based on cost incurred. Input, cost incurred to date over what? Total cost expected of the project. Okay. So the cost incurred is 14. Total cost expected is 21. Okay. So we can calculate this, right? 14 and just a second. Let me be sure. We'll find it in the slides in the next section, but just to put this as a teaser ahead of time. So 14 by 21 giving us some 66.7. Okay. Giving us some 66.67%. That's the rate at which we've completed. So they measure progress using the input. At 31st December, they had received 12 million from the customer. That's the amount they have received so far. Okay. How should above be reflected in the books of the company? Okay. Typically, like I said, you would be expecting that your 30 revenue contract price minus what you have incurred to date and what you expect to incur should give you the profit. This is what you expect. This is what at the end of the day you would get. But currently, we have only completed 66.7% or 66.67. What portion of the revenue should we recognize? This guy has given us what? 14 million. Okay. But the profit to date, we are expecting 9. Should we recognize all the profit? No. Just recognize 66.67% of the 9. Okay. And then, so that is it. So overall, okay, the cost to date is 14. Okay, the cost to date is 14. Add your profit portion that you expect, the 9, okay, which gives us this 6. And then how much have you received from this guy? 12. So the contract asset receivable, okay, the contract asset you should recognize, I don't want to say receivable, is 8. It's 8. Okay, so your cost to date, add your profit portion, okay, and then subtract how much you've received is left with 8. That's the contract asset we need to recognize in our books. So in the books of your statement of profit and loss, your total revenue is 30 million. That's what I'm expecting at the end of the day. But as at now, I can only recognize 66.7% of it. That is what? 20. My cost of sales total, the total cost I would incur, the 14 plus 7 overall, I've only finished 66.7, so I can only recognize 66.7, which is 14. So my gross profit becomes 6. My gross profit becomes 6. Okay. Can you realize that the 6 jives with the profit to date? It jives with it. Okay. Because you are just recognizing a portion that you've completed up to date. And then your assets, your contract asset has been calculated. So just keep it as 8. Okay, that's how we just identify it on our current asset as contract assets. Okay. All right. And we have said about this contract asset that over time we will amortize it until when we have clearly cleared all the revenue recognized. Okay. All right. Again, what if the obligation is satisfied at a specific point in time, not over time? Okay, this is where we say that the customer obtains control of the asset immediately. Okay, at a point in time. At this point, we just hand it over to him. He takes over. Okay. Now, an entity will control this asset if it can direct its use and also obtain its remaining benefits. We have been told that some indicators that shows that we have passed the control from from the seller, the vendor, the contractor to the customer include one, where the customer has physical possession. He takes custody of the asset, where the customer now takes over all the risk and rewards associated with the ownership of the asset. So he can do whatever he wants to do with it, more or less. Okay. Where the customer then also gets the legal title to the asset in his name, and where the seller has the right to payment. I've handed it over to you. You are enjoying the risk, the benefits. You have the title, give me my money. Okay. This is where we talk of the situation that you have actually satisfied the obligation. At that point in time, you've handed over control of asset to the customer. Okay. Take an example here. A combined sale on 1st September 2017. And once again, I will always entreat you, be careful of the dates. On 1st September, Selby sold a machine, including 2-year technical support for $396. It will usually sell this machine at 300. It means an excess of 96 more or less appears to be the technical support for the 2 years. But does not sell technical support for this machine as a standalone. So you buy it and I'll add the technical support and I give it to you. Okay. Other support services offered by Selby would actually attract a markup of 40%. It is expected that technical support would have cost Selby $50 a year. Okay. So you would have realized that if it was a full year, then we need to find 40% of the 50. Okay. And then add it up to the 50, right? Or simply 1.4 times the 50. Okay. How much revenue should they recognize at 31st December? Be careful of the dates. So 1st September to 31st December, including a 2-year. How many do you see over there? 2 years we are talking of, right? And 1st September to 31st December. Okay, 1st September to 31st December is 4 months, right? It's 4 months. But in reality, we are talking of a 2-year support we would have given to this guy. So in any case, there will be some form of prorata of 4 against 24. Okay, take note of this. How much revenue should they recognize? Have they earned? Okay, so the machine sale totally would have been 300,000, not 396. Typically, it would have been. Like I said, the support would be the 1.4 times the 50 times 2 years. Every year for 2 years. So this guy would have actually benefited from this. So in reality, we should have charged him 440. In reality, okay? In reality, this is what we should have charged him. But we gave this guy 396. So it means that this 440 minus the 396, the guy has actually gained what? 44,000. It is like a discount, isn't it? Okay. So express your 44,000 as a percentage of 440,000, and it gives us what? 10%. So more or less, he's gotten 10% discount. Now let's apply the 10%. It means that this machine cost of 300 should be adjusted to 90%. And this one also should be adjusted to what? 90%. Okay. So in reality, this 396, and you've seen that we did a similar example in the previous slide. So apply 90% to this, right? And 90% to the total 140, okay? And it still jives with our 396, which we actually sold to the customer. Is that all? What about the prorata for the very first year? What about that? So this actually to 126, should we leave it that way? Or should we prorate it? Okay. And so that's where we come in. So the machine should be recognized in full. Don't prorate it. You've given it to him. He's accepted it. Because at that point, the machine has been given to him. He takes control. He benefits the reward. And it's not in piecemeal where we have to allocate it based on the percentage of completion. We've given everything to him, so recognize everything in full. But for the technical support, it will span over 2 years. So we need to recognize it according to the time frame. So that's why I'm saying it is 4 months from September. So these 4 months you see is what I mentioned, September to December, over the total 24 months, times the actual cost, 126. For the year 31st December 2017, this is what we should recognize as our total revenue. Easy, right? And then the subsequent years, you will recognize the extra support that you have been given to them as part of your revenue. Okay. Again, we are finishing soon. Okay. There are certain types of contracts. Let me just keep this item on for now. There are certain types of contracts. Which are specified within the FR syllabus. Okay. Consignment, sale and repurchase, bill and hold, principal agent. In terms of consignment, we are typically talking of you sending some items of goods and services, items of goods usually to the supplier, to the seller. Seller and supplier is the same. To the customer, you are supplying some goods and services to the customer. Okay, where the buyer or the customer takes control. In that case, once it takes control, we establish that revenue has been earned, so we can recognize it. Okay. So a typical example here on January 1, and I'll always be careful of my dates so that I don't get confused along the line. January 1 and 31st December, okay, the same year. So that's full year, no headache with prorating. So the manufacturer entered into an agreement to provide Canterbury, a retailer, with machines for sale. The terms are as follows. Canterbury, the customer, will pay the cost of insurance and maintaining the machines. It makes sense when I sell my car to you. If I'm a car dealer and I sell a car to you, you don't expect me to be maintaining and insuring the car. I think it's yours to do, okay, to keep. Canterbury can display the machines in his showrooms and use them as demonstration models. Oh, okay. So I even go to the manufacturer, buy the cars, I keep it in my showroom. I can demonstrate it, come and look at it, and then you buy, okay. Whenever a machine is sold to a customer, Canterbury will pay Gillingham the factory price at the time the machine was delivered. Oh, that was interesting. So if at the factory price, it was factory price, okay, is let's say 10,000, but I sell it for let's say 12,000, I will end up paying you, the manufacturer, 10,000, and I take some 2,000 as profit. It makes sense. After I'm insuring it, I'm maintaining it. Okay, that will also cover some of my operational costs. Yes, all the machines remaining unsold 6 months later, after the original delivery, must be repurchased by Canterbury at the factory price at the date of delivery. So if there are excess, at the end of the day, there are 6 machines which I have not sold after 6 months. Okay, then we are being told that I'll have to buy it at the cost of the factory price. I'll buy it as the customer who has taken this delivery of the assets. Again, there's the option that Canterbury can return the unsold machines to Gillingham at any time during the 6 months. So if I realize it is 5 months, 20 days, I can return it without any penalty. But in practice, this has never happened, which means that technically, almost every time, the items are all being sold, or Canterbury ends up buying them after the 6 months. But in theory, typically in practice, he's not returned it to the manufacturer before. At 31st December 2016, the agreement is still in force, and Canterbury holds several machines which were delivered less than 6 months earlier. Beautiful. How should these machines be treated in the books? I'm looking at my time. I should finish this. We don't want to defer this. How should these machines be treated in the accounts of Canterbury for the year ended 31st December 2016? So like I'm saying, the key issue is whether Canterbury has purchased the machine or whether they are merely on loan. So we have to determine where control has passed on to Canterbury. So Canterbury, we are saying, can return it without a penalty. So it means Canterbury does not really have automatic right to retain them. But in reality, we have been told that it has never happened. Okay, Canterbury incurs the insurance and maintenance, so they are normal, like I said, deals with holding costs. Okay, inventory, warehousing costs. Okay, the purchase price is the price at the date the machines were delivered, and Canterbury can sell it at a profit. Similarly, if the price drops, he will bear the loss. So he's now bearing the risk and rewards. He's taking possession of the assets. Okay. They said he's taken possession and he's held several assets even after 6 months. Now he could have returned it, he still kept them. He will suffer from any slow payment or obsolescence. But in reality, they said he could have returned it before this time to limit the exposure risk of keeping these items in stock, which could run into obsolescence. So they've all experienced some risk and rewards, some benefits. I give it to you at 10,000. You sell it for 12,000. You give me 10,000. Okay, I also have to bear the cost of warehousing and everything. But what we are hearing is that however, regardless of the risk and benefits, the agreement provides for the return, but it has never happened. It's never happened. So return it. So this automatic right can then be questioned. He hardly returns it. Okay. So what do we have to say? We can say that the machines are for Canterbury. He holds the possession. All the conditions have been met. Okay. He benefits from the risk and rewards. The seller has the right to claim payment from this guy because it never returns them. Okay. So it should be included in Canterbury's statement of financial position, and Gillingham can actually recognize machines once these are dispatched to Canterbury, because it has never happened that this guy will return it. Why do I need to wait till after 6 months before I recognize my revenue? He will keep them or he will buy them. He will suffer the ultimate risk and rewards. Okay, that is it. Sell and repurchase. So I sell a big house to you, a big office edifice. I don't really need it, and I take a little part of it to use as a bank. It happens mostly, right? So a sale and repurchase is where the entity will sell the asset, but he retains the right to repurchase the asset. Sometimes later on he will purchase everything back. I give you my building, okay, and then I have the right to claim it later on, okay. Where the repurchase is likely to occur and control of the asset is retained by the seller, this agreement is not recognized as a sale, but as a secured loan against the asset. Okay. What we are saying is that yes, the purchase has occurred. Control of the asset is still in the hands of the seller. So I'm actually controlling it. So more or less, it is not like a sale, but it's like a loan that I've secured against the asset. I've given you a loan, okay, or you have given me a loan, okay. So you don't consider it as a sale. Let's take this example. Javier sells his head office. It costs 10 to Yorick, a bank, for 10. Okay, on 1st January, Javier has the option to repurchase it after how many years? 2012 to 2015. So the whole of 2012, 13, 14, 15. After 4 years. Okay, 4 years later. All right, for 12. Javier will continue to use the property as normal throughout the period, and so is responsible for maintenance and insurance. I have sold it to you, but I'm still using it, and I'll pay insurance and maintenance. The head office was valued on transfer at the transfer date of 18, and it's expected to rise in value throughout the 4 years. Do I really need to worry my head about the value at transfer? What did I actually sell it for? I may have lost from the market value. It was 18 and I sold it to him at 10. And in fact, he himself has also agreed that 4 years later, sell it to me, or he will sell it back to me at 12. When the current market value is 18, do I need to worry my head about the 18? I need to talk about the real. Well, in books, on the face of the books, you can say you've suffered some loss. But what I need to worry my head more about is the 10 million actual cost and the 12 million that I will repurchase. Okay. Giving reasons show how Javier should record the above during the first year following the transfer. Okay. So here, Yorick bears the risk of falling property rises because currently when we are transferring it is 18 on the market. but Yorick has agreed he will give it to you at 12. He will suffer that risk. But Javier, the seller, continues to use the property. Okay, he will continue to maintain and ensure he's more or less gain control over it. He will benefit from property rises. He will buy it in 4 years' time at 12. At which point we are being told that the value of the asset will keep rising. So more or less, he's benefiting totally at the end of the day, he's benefiting. So Javier should continue to recognize the head office as asset in his books. Okay. More or less, what we are saying is that I have sold it to you for 10 million. I've taken the money from you. You are my customer. Okay. I've taken 10 million from you, but I said I'll pay you 12 million after 4 years. It's like going for a loan from the bank, 10 million. And then the bank says after 4 years, you pay me 12 million. What's the interest component? The extra 2 million. So that's a sale and repurchase. So typically we see this, that the interest component is a 2 million. Is a 2 million. Okay. All right. Over the 4-year period. Bill and hold. Sometimes you have sold the item. The person says, give me the car, but keep the spare parts because I don't have a warehouse. And I keep it. Okay. But I can come for it anytime I need. Okay. So the bill and hold talks of where there's a contract. The seller has invoiced the customer for the product, but the product is physically retained by the seller until it is transferred to the customer at some point in time. So we are saying that for this to be recognized within revenue, the customer should have control over it, not the seller. If the seller is holding, then it will be more like a sale and repurchase. Okay. So sale and repurchase is more like seller focused, whereas bill and hold deals with customer focus, customer control, and seller control. Okay, those are the two dimensions. Let's take a simple example. On 31st December, okay, time is gone, but let's finish this up. Okay, we are finishing soon. Clarence sold a machine with a spare parts for 500. The machine was for to 80, spare parts was 20. And then Clarence delivered to the customer on the same day, but he was asked to keep the spare parts because the customer's warehouse was close to the seller's factory, and Clarence expects to hold the spare parts for 2 to 4 years. So the seller will still keep it for 2 to 4 years. The parts are kept separately in the warehouse and cannot be used by the seller. He cannot control it. He cannot benefit from it. And they are ready for immediate shipment. Immediately the customer calls for it. Clarence agreed to the transaction as he decided that the holding cost would be insignificant to him. Explain the financial reporting treatment for the issues for the year ended, okay, 31st December 2021. So it's a bill and hold agreement. Yes, the supplier retains physical possession, but the control is in the hands of the customer, Edgar. Okay, we can see this in the fact that Clarence cannot use or sell these parts, and he must ship it immediately upon request by the customer. So there are potentially three potential performance obligations here. One, supply the machine to the person. He takes it. Number two, supply the spare parts to the customer. He takes possession of it. Number three, keep the spare parts for me. Those are the three performance obligations. Okay. So the performance obligation to provide the machine and the spare parts are met on the date we dispatch to the person. So we recognize it, the whole amount in full, the 480 plus the 20. Okay. Now they said the storage costs are insignificant. Okay. But assuming they were significant to the seller and therefore part of the transaction price, then the price related to this performance would also have been separately recognized over the expected period. But it says insignificant, so I don't want to include it as part of the cost. Otherwise, I would have to recognize it. Okay. Finally, friends, we take principal and agent, where you sell and you get a commission. You must only recognize the commission, not the total revenue. So if the agent sells and is getting a fee or commission, just consider that. Rosemary's revenue includes 2 million worth of goods it sold as acting as an agent for Elaine. Now, Rosemary should typically have earned 20% of this on these sales and remitted the balance of 1.6 to Elaine, but he has included the 1.6 in his cost of sales. Okay, so typically This person has recognized excess of 2 million. He shouldn't. It should be 1.6. So he must reverse these transactions. He must reverse it from his cost of sales and his revenue, whatever, wherever he's posted it. Okay. How should agency sale be treated in the case of Rosemary's profit statement of profits or loss? Okay. So, like I said, he's only entitled to 20% of the sales. That's a fee. That's a commission that he's entitled to. So he's supposed to get 400, but he's recognized the whole 2 million. So what will happen is that reverse it from your revenue. Okay. So revenue would have been credited with the 2 million. Reverse it with the 1.6 and reverse your cost of sales, which you've increased by 1.6. Okay. That's it. And you are done. At this point, I'll ask you, friends, take a look at the TYUs, all of them from chapter 11 of the text. Read the text once again, okay? And you should be able to go through all the illustrations, answer all the illustrations, the study text. And then provided you have the exam kit, which I think most of you don't have, no worries. I'm going to repopulate a couple of these. I will adjust the numbers a little to be within the copyright laws, okay? So, but I will still align it to this so that those of you who may have the study kit, exam kit, you can easily do more practice, okay? Realign it. So samples of these past questions will form the basis of our tutorials, and we'll pick one or two from other sources just to embellish our work, okay? To make it more varied, okay? All right, so friends, I end here, and it's good to see you. I'll see you again in class and online. Bye for now.